You may have been told that indexed universal life is the new whole life on the block.
You are listening to Wealth Talks with Tom and John McPhee, where we talk about solutions for your prosperity. Indexed universal life insurance. You may have heard us talk about this before. It's an ugly giant that keeps rearing its nasty head in the insurance world. And this ugly giant, it's popular. It's the sales have massively increased over the past 15 years, and the appeal is that you can get in on the market returns while still having a foundation of guarantees in the policy.
In fact, is the objective goal of IUL policies, which is an abbreviation for Indexed Universal Life, is to outperform the index they're mirroring, which becomes a practically impossibility because you have to overcome the ever-increasing cost of the term insurance that is the basis of this policy. So if you're trying to outperform the index and having to overcome an ever-increasing cost of term insurance in the policy, you have this dichotomy that you're fighting against yourself. And so we see the guaranteed values in an IUL policy always dropping off and even disappearing in the years where you're most probably going to die, unless you have what's called a no-lapse indexed universal policy. And in that case, you're paying way more than what you should for your insurance.
For the insurance. So yeah, these policies, they do have this no-lapse thing because they know that cost of insurance is going up in the background. But the guarantee on that rider is often tied, maybe you do have a guarantee on that. You're going to pay more for it. Like you said, even then, it's often tied to whether all your payments have been on time.
Oh, yes.
If you're on a monthly premium payment, what is the chances over 20, 30 years of a single premium payment being late and possibly nullifying the guarantee that you thought you had of a no lapse in that rider?
And the answer to that question is just to look back and see if ever you've had a utility bill, a phone bill, a water bill, or any other bill paid late. Not by your fault, but maybe by a lapse in electronic transfer, maybe by a lapse of the U.S. Mail Department, or maybe just because of insufficient funds, because your checkbook didn't balance that month.
It happens, but you shouldn't lose your guarantee because of that. So you always have to check the fine print for that if you do want an IUL policy. But we're going to go through some reasons why you might not want the IUL, even if you did get that guarantee. And
so to understand that, we really need to understand what an IUL policy is.
Certainly. So what is it?
An indexed universal policy is a universal life insurance contract.
Sure.
Universal meaning that it is based on 1 year renewable term or annual renewable term insurance, which starts out relatively low if you're young and healthy. Mm-hmm. But every year you live, you're closer to the point of dying, so the premium rises on that.
Okay.
So what you might start out with in your 20s could end up costing hundreds of thousands of dollars every year by the time you're in your 60s. Mm-hmm. And what the indexed universal life insurance product is counting on is that by overpaying premiums when you're young, so paying more for coverage than what you could get it just by buying simple term insurance.
Sure, so you'll be able to build more value in the policy.
Then there will be some money left inside the policy, which is put in an accumulated cash value account, and that will mirror an index like the S&P 500 or the Russell index or some other index, or maybe a combination of indexes.
So the idea is here that as you're earning interest on the index or whatever, or earnings or whatever you want to call it on that index, that the value of your cash, your side account, will grow faster than the cost of the term?
Yes. And so, the problem is, though, that this mirroring has a cap on it.
Okay.
So typically the caps are somewhere around 10 to 15%, depending on what the contract is. So let's say that the S&P that you're mirroring goes up 30%, and your cap is 15. That means you only participated in 50% of that growth. The other 50% was lost to you because you couldn't participate in it.
But you also,
But your cost of insurance is still going up.
yes, and I'm going to play the other side here for a second. But you also would have a guaranteed floor, right?
Oh,
Couldn't go
absolutely.
below a certain point.
And that's the huge selling point of these, is that they say, well, that's guaranteed that you can never lose money
in the market.
in the market side. They don't say you can't lose money in the policy. They just say you can't lose because the index went into negative territory.
So how would you lose money in the policy?
Well, there's fees associated with universal life, as there are with all insurance policies. It's just that with term insurance and with whole life insurance, those fees are level and fixed. So you know exactly what they're going to be, and they come out of your premium every time that on an annual basis.
Yeah, sure.
Somewhere around $75 to have a policy that's term or whole life. That's the flat fee forever. Well, let's say that you're paying you're paying $10,000 for a premium on a whole life insurance policy. The fee's $75. If you're paying $10,000 on a universal life policy, the fee is 6% of what you paid. So what is 6% of $10,000?
Yeah, 600.
Oh, that's a little bit more than 75, isn't it? Yes. And so the fees, they usually last for 10 to 15 years, depending on where the surrender values stop. And then they're reduced. Sometimes they're reduced to 1%, sometimes 2%, sometimes 3%.
Sure.
But they're still taking a chunk out of your premium every year, which is significantly more than what you're going to pay for a fee on a term policy or on a whole life policy. Mm-hmm. So that's one of the risks that you assume, is that if this fee is consuming 6% of the premium you pay, and you are in a negative index return for the year, and you only got 1% return on your accumulated cash values, but you're paying 6% on your premium that you paid that year, you could actually lose money in the policy, and you do. And we see this time and time again, so that the guarantees in the policies run out when someone's nearing 70, 75, because of that increasing underlying cost of insurance, the fact that the cap kept you from earning 100% of the index return, and the fact that you had fees to pay on a percentage basis of what you're paying in premium.
Okay, so a lot of different fees that are associated with that, and if your head is spinning with all those different types of fees, it's not easy. It's a little bit complex here, and that's one of the things that can be tough with any type of product. Is if the fees are too complicated to understand, you better think twice about what might be going on in that product that you won't understand with the outcome.
Well, that's an underlying rule in every contract. The more complex it is, the more pages it takes up, the more you can realize that contract was not written for your best interest. It was written by the lawyers of the person that you're entering the contract with.
Yeah, good point. Good point.
Complexity of contracts does not do well for the person on the receiving end of that contract.
Yeah. So some of the risks that are associated with index universal life, you're not necessarily earning your rate of return on the money that you take out anymore. You'll be charged fees, interest when using that money. You could reduce your opportunity to generate more cash value when you lose money from the or use it outside the policy. Policy could lapse. Depending on how it was designed, or if those guarantees are there or not,
and
as
if
the
it
cost of
lapses,
insurance goes up.
And if it lapses because you've been depending on the cash values in the policy to pay the premiums, which a lot of people encourage because they call this flexible or variable premium life insurance.
Sure,
it's almost encouraging you not to pay more money in the front years. And if you don't pay those high premiums in the front years, then you're cutting off two things. You're cutting off the compounding growth that could have occurred if the index does turn positive for you year after year. And if you're depending on those cash values to pay your premium, you're reducing it every year. And so you're losing compounding growth there as well.
Yeah, that's not fun. So definitely some risks here associated with index universal. And on top of it all, to cap it all off, your guarantees are minimal and your earnings are capped. So how much are you really following the market that you set out to try and outperform?
Yeah, and these limits, these risks that you're associating, make this product a very unlikely source to build sustainable wealth, to secure a loan like a mortgage where a bank needs a life insurance policy. To
Sure.
do
They're
that.
going to be less likely to take one of those policies.
They want at risk. The United States government won't allow an IUL policy to fund your to be something that you fund an IRA with, because they know this risk is down. You don't want to sell a buy-sell agreement, fund a buy-sell agreement with this, because the funds could disappear on you. Retirement plans and anything else that needs binding contractual guarantees, this is not the product that you need to be looking at.
Don't depend on it. Okay. So moving on a little bit from this, we talked a little bit about the inner workings of the Index Universal policy, how it buys term insurance, how it tries to follow this index. What about some of the fees that are associated with the policy?
Well, we talked about the premium fee.
Sure. 6%.
I think that's one of the biggest things that people need to understand, that premium fee can be so much more significant than in other types of insurance that are available. Mm-hmm. And then we also discussed the fact that you're kind of being charged a fee because you don't get to participate in the whole index return. Mm. So
that's a handicap.
It is, and when you look back on the way the index, performs, yes, it does do about an 8 to 10% average rate of return, but that's made up of a lot of high yields, and then there's some negative ones thrown in there as well. And what happens is, even if the index is positive for the year from January to December, it might be negative from March to March.
Okay.
It might be positive from June to June.
So they can split the year differently.
And so if I'm buying my policy in March, I could end up with a negative return even though the overall average was positive for the year.
Okay.
Because then we get to work in how these policies actually accrue that interest. Some of them look at the average fluctuation of the index on a month-to-month basis, add that up and get the multiplier that they multiply your accumulated cash flow with. Some just look at the return for the year. Some of them look at, so there's all different ways that they can tabulate what the index actually did. But
is your head spinning yet?
So the real reason is this is complex.
It is.
Okay?
It is.
So this is an issue, because if you don't understand how that return is going to be tabulated, how can you know what you can expect in your cash value?
This is, this is sounding more and more like an investment where you don't know the risks that you're taking on, rather than a true savings. I mean, why wouldn't you just, if you're going to make the investment, why wouldn't you go invest in something that's a little bit more simple, that has less fees? Why wouldn't you invest directly in that and buy your insurance separately?
Yes. And we haven't even talked about participation rates yet. Okay. And participation rates allow you to determine how much of your accumulated cash value you want to participate in any one given index.
Sure.
Maybe you're going to usually they limit it to at least 25%, but it might be that they limit it to 50%. So you don't have a choice. You may have a choice, but it's going to be limited. Whereas if you were making a direct investment, you would make that decision instead of the insurance company for you. So this becomes an issue because we're looking at trying to give you a contract that is guaranteed. And this doesn't guarantee that your policy cash values will grow. All it does is guarantee that you will not lose money if a negative return happens in the index that the policy is mirroring.
And not even that you won't lose money, but you won't lose money on the market side.
That's correct. That's right.
Unless you have that guaranteed rider, maybe. So yeah, all of these different rules. Well, what about dividends though? Could you earn dividends in an IUL policy and get part of the profits of the company?
Well, that's a good question. And dividends brings up two types of dividends.
Okay.
Indexes, the S&P 500 has a dividend.
Sure.
The Russell has a dividend. Dividends are not allowed to be figured in the returns that is being mirrored by the insurance company.
Yeah,
and that's a huge portion of it.
Yeah, and that's because you're not, here's a secret, you're not actually invested in the index that you're investing in. You're just mirroring the index. And the way the insurance company does this is to buy options on the index.
And so this last year alone, that means 20% of what the S&P 500 returned, you wouldn't even be able to participate in, regardless of what your participation rate was in the policy. Okay. So that's just cut out.
All right. So those dividends are out of the picture.
Those are out of the picture.
What about dividends sharing the profits of the insurance company?
Well, that's a good question, because a lot of whole life insurance companies now are allowing the dividends that they pay to participate in indexes like this. And so we've got a whole life policy now that is being treated like an IUL policy.
Okay.
And so, regardless of what happens here, the idea that the profits that the insurance company is going to share with whole life policyholders are not available to index universal life policyholders because they didn't buy a participating policy. They did not buy paid up insurance. There is no equity inside an IUL policy. The equity in whole life insurance is what gives you your dividends, because you own part of that death benefit. The company's still managing the premiums you paid for that death benefit, so they share the profits they earned with you back on those premiums they're managing.
So, and that's an important difference. So a whole life insurance policy can be participating because you're a part owner in the company. Even though you have a participation rate with an IUL policy, that participation rate is talking about your market participation rate. It has nothing to do with the participating in the profits of the insurance company.
Remember, IUL is based on a term product where you're renting insurance from year to year with an ever-increasing rent fee that's added every year.
So you could almost make the case that the profits that the insurance company is making on index universal life insurance are really coming back to help the whole life policy owners, because we get to share the profits of the of what the insurance company is making on all the IUL policies.
Well, that brings up a good point, because every insurance company I've ever asked is, why are you selling index universal life? They give one answer, and that is, it takes the risk off the company and puts it back on the policyholder. And if you're someone who likes to assume risk, then IUL might be something that you want to look into. There is some value in owning universal life universal life insurance, index universal life insurance.
So what would that be?
Well, the initial cost could be lower than a whole life policy.
Sure.
Okay, but remember that flexible premium. If you don't put as much in, the compound's not going to be there for you in the end, and so it's not a long-term solution if you're going to start with a low premium.
Yeah, and that brings up a question here, because the initial costs could be lower than whole life. So if you plan to get rid of the policy at some point in the future, you might be able to walk away with a little bit more than the whole life. But why in that case would you tie up the money at all? Why wouldn't you just buy term insurance?
That's right, and that's what universal life policies in general are trying to keep their position in the market with the old saying, buy term and invest the difference. They didn't want to be left out of that equation, so they came up with universal policies so that you buy term, but they invest the difference for you and give you a profit of some of the profits they made.
Well, that's a classic case of introducing the middleman. And the middleman's always going to have a fee associated with that. So why not cut out the middleman in this case?
So another advantage, if you want to call it that, of owning indexed universal life is premiums can vary widely without triggering tax liabilities.
That is a plus.
That's a plus.
So you could have a little bit more flexibility on it. Nice years, you could put more money in. Doesn't necessarily mean you'll ever be able to get that money out if it disappears before that.
It is classified as insurance that allows the cash value to grow tax deferred.
Okay.
So if you believe the risk is comparable to your tolerance, then maybe you want to have a universal life policy, index universal life policy for a number of years to see if you can't build cash values higher, okay? And that's going to be tax deferred up until the time you withdraw it. Surrender values on accumulated cash value can still be accessed for any reason, so you can borrow against it.
Sure.
Out of pocket premium expense can be flexible only if you've got enough accumulated cash value to cover the difference that you're not going to pay out of pocket for the premiums.
And that's why you see all the news articles with people that have these universal life policies having to pay the ever increasing cost of premium. They got behind that power curve.
That's right. Transamerica just paid several $1 million to settle a case where people thought they were buying permanent insurance and then see these ever increasing premium costs.
No fun.
They said that wasn't what we signed up for. Okay. And you can add a rider, like we mentioned right at the very first, where you can guarantee the face value to increase or for a no-lapse contract. But that is a paid-for rider.
Yeah.
And it's going to
have a cost.
Significantly more expensive than buying term and investing in the difference.
Sure. So with these, we mentioned earlier, maybe the IUL is a good thing for whole life policy owners because we get the profits. We get to share in the insurance company's profits. But if they're having these lawsuits that you talk about where that are coming back, then those profits from the IUL contracts might disappear fairly quickly.
Well, there's a lot of concern among some agents that have been selling insurance for a long time that the indexed universal life product is going to damage the industry some more, just like universal policies did in the 70s. Because universal policies didn't mirror an indexed. They usually mirrored the LIBOR, which was the interest rate that banks charge each other when they're borrowing back and forth. And so when that interest rate fell from 17% down to, sometimes negative, the returns that were promised in these universal policies just didn't materialize. And so people were having to pay premiums when they thought that this was going to be premiums paid out of their cash values for a lifetime. And so those people are now being stung by those, and that's why we're seeing, multiple lawsuits, not just with Transamerica. Forbes and Wall Street Journal and some other people have reported on this quite extensively.
And the same downside is still encapsulated in the IUL product because it just depends on the market now instead of the
same
rates
basis
that the banks were lending to each other upon.
Yeah. So the downside to owning an indexed universal life are your growth is capped.
Yeah.
You're limited. Participation rates can be less than 100%, which can limit you from earning the full potential of the S&P.
Yeah. Why would you go for that?
Larger policies tend to outperform smaller policies. So even though you can start with a lower premium, as we mentioned earlier, that isn't in your best interest.
Yeah.
Because we're looking for enough money in that accumulated cash value to actually grow to overcome the cost of the insurance. Gains are only possible with upward movement in the index.
Okay.
Because
if it moves down, you just have that cap on the floor.
Yeah,
that floor.
And so many people, that are good investors make their money when the market turns negative.
Yeah,
George Soros, Roger Jones, Jim Rogers. A lot of people make their money on the downside.
Yep.
So
that is out with an IUL policy.
Policy contracts are complex, and complexity never favors the policy owner. Never.
As you were going through all those factors in there, even my head is spinning a little bit, trying to put it all together. And I'm somewhat familiar with the different conditions and the general way that index universal life insurance works. I can only imagine as you're listening to this, if you don't think about insurance very often, trying to follow all of those conditions, it makes your head spin.
It is.
It is definitely complex.
And, it doesn't make it any easier when the legality to describe this product, when they call it a permanent life insurance policy.
That is a problem.
That's a problem because it doesn't have the necessary structure behind it to be permanent unless you continue to pay those high premiums. That's the only way that it can happen.
And that's kind of people are excited about complexity, new technical inventions. They think it's the leading edge. And maybe sometimes that clouds the judgment behind what is really behind that complexity. What is the real value that it is creating in the marketplace? Or is it creating a value in the marketplace? Something that's good to consider regardless of what you're investing in or where you're planning to save. Wherever you plan to put your money, you want to make sure that it's going to be there for you because your whole goal is to keep more of the money you make and not lose it.
One of the other downsides, and we've mentioned this before, is the goal of IUL was to outperform the index or the market.
Yeah.
And the probability of that is significantly slim because of the ever-increasing cost of insurance. Due to the fact that this product is marketed as a flexible premium, variable premium product, it entices people to pay less than what they need to up front. So the compound growth doesn't occur there early enough to offset the cost of that ever increasing. And because of the fees that are charged on premiums in those upfront years, that limits your potential growth.
Yeah.
And finally, IUL contracts don't pay the dividends included with the index if you were trading the index, because like you mentioned, John, they're only the insurance companies are investing in options, and the options are not participating in those dividends.
Yeah.
So this becomes something that people really need to understand if they're thinking about IUL, if they're thinking about buying a permanent insurance, that they not get involved in trying to compare the non-guaranteed values with what they're going to need in retirement.
Yes. That
Look
key.
at the
Look
guarantees in an IUL policy. In fact, is in a whole life policy, if someone's selling you a policy based on the non-guaranteed values, you need to seriously consider finding another advisor.
Yeah, look at the guaranteed side.
It's only the guarantees that are contractually there for you, okay? It's all about you. What do you want to accomplish? Do you want to pay more or less? Do you want to face ever-increasing costs year after year? Do you want to build strong, binding contractual agreements? Or do you want one that is very weak, that has a lot of complexity in it, that is put in there to, not necessarily to confuse you, but to give the insurance company an advantage over you if there's ever a dispute?
Yeah.
Finally, do you want to speculate, and do you really want coverage that's going to last a lifetime?
Yeah, these are questions you need to think about. And what if you're listening to this and you already have an IUL policy? Is it too late? Should you stick with what you have? Should you get out of it, drop what you have and run and cut the losses? Or should you keep it for a while to minimize the surrender fees? Those are questions that we will be able to help you answer. We can't. It's not a one size fits all answer. So give us a call at 503-363-5433. You can give us a call there, and we'll be able to help you work through that and even take a look at your policy with you so you know the best options going forward.
It's been said that you should never take sides, and successful people don't buy that advice. They always take sides. Think about your favorite football team. Okay, whether they're doing well or whether they're doing poor, you're going to take sides with them. Think about your relationships. Think about your family. If you don't stand up for those values, and as you listen to this podcast, you can see that we're very biased. We have a one-sided opinion that whole life insurance is much better than IUL for certain things, and yet we even took a little time here to show you some of the positive things that IUL can have. But we're very biased, and we're biased for a reason, because we've seen so many people hurt and financially crushed when they've had these universal products. And the hurt and the feeling of being betrayed by the agents that sold them to them because they thought they were getting something that was guaranteed. And we just don't like to be... we don't like to see people hurt like that, and we don't want you to be hurt like that either.
So give us a call. We'll be able to help you look at what you have. Or if you don't have a policy yet, we'll be able to help you get the kind that does give you real guarantees, lets you save money, get with the liquidity, and keep more of the money that you really make. I realized just a second ago when I gave you our phone number, I gave you our old phone number from Oregon 5 years ago. It still comes through to the office, so you can also contact us, 702-660-7000. We'll be able to help you with that policy review. So you're listening to Wealth Talks, where we talk about solutions for your prosperity. Have a wonderful week.